Welcome to this explainer. Look, if you're on unemployment in Minnesota and you're picking up part-time shifts or occasional gigs, you absolutely must know exactly how to report those hours. Making a simple mistake with these strict state rules could literally cost you thousands of dollars. So grab a notebook because we're going to dive right in and make sure you know exactly how to navigate this system safely.
So let's start with a scenario that catches so many people off guard. What actually happens if you just guess or estimate your work hours on your weekly unemployment request? You might think, hey, a rough estimate is fine, right? I'll just round my 12-hour week to 10 hours since I don't have my timesheet right in front of me. Well, no. Guessing like that can trigger an immediate fraud determination from the state. The system is built entirely on precision, not approximations.
The cost of getting it wrong, it's honestly staggering. Minnesota enforces a massive 40% penalty on any benefits they decide were fraudulently obtained. Let me just repeat that, 40%. And that's on top of making you repay the original amount. Oh, and to make matters worse, that penalty accrues a 1.5% compounding interest rate every single month. So yeah, we need to make absolutely sure you never make a reporting mistake that puts you in that position.
To keep you totally safe and compliant, here's our roadmap for today's explainer. We're going to cover 1. Why accuracy matters, 2. The performed versus paid rule, 3. The 50% rule, 4. A step-by-step reporting guide, 5. Common mistakes, and finally, 6. Best practices and a quick disclaimer.
All right, let's jump right into Section 1, Why Accuracy Matters.
If you misreport, the state doesn't just send a polite little warning letter. They aggressively recover those funds. Right off the bat, there's the mandatory repayment of the overpaid benefits. Even if it wasn't intentional, they'll mandate repayment and can automatically offset up to 50% of your future benefit payments until that debt is completely cleared. But if they deem your misreporting as intentional misrepresentation, which by the way, they can do if you knowingly make a false statement or even just fail to disclose facts, boom, that 40% penalty drops, plus that 1.5% monthly compounding interest we talked about. And if the value of the fraudulent activity is over $500, you could actually be looking at felony criminal charges.
This really hits the nail on the head regarding how the system works. Minnesota law does not allow for overpayment waivers under any circumstances. There is literally no honest mistake forgiveness program here. You can't just call them up and say, "Oh, I'm so sorry, I didn't understand the form." You and only you are held completely responsible for the accuracy of your weekly data.
Moving right along to Section 2, the performed versus paid rule.
Now, this is absolutely crucial. By legal definition, you must report all hours worked and all gross earnings during the exact calendar week, which runs Sunday through Saturday, in which the labor was actually executed. You completely ignore when your paycheck is issued or when an invoice finally gets settled.
Let's look at the difference here, because this is the golden rule of Minnesota UI. On the left side, we have when you perform the work. Say you work a shift on a Tuesday, you report it on your weekly request for that specific Sunday to Saturday week. Report it immediately. On the right side, we have when you receive your paycheck. If your boss pays you 2 weeks later, do not wait for that paycheck to report the hours. The state only cares about when you did the physical or intellectual labor, period.
All right, let's get into Section 3, the 50% rule.
Minnesota uses a very specific formula to calculate partial benefits. In plain English, the system essentially ignores the first 50% of what you earn in a week before they start reducing your unemployment check. So, for example, if you earn $100 in gross wages, the state deducts 50% of that, which is $50. Your UI check is then only reduced by that remaining $50. If you earn $200, your check is reduced by $100. So, as you can see, you are almost always financially better off working those part-time hours than not working at all.
Just a quick side note for the entrepreneurs out there. If you own 25% or more of a business, or a close relative like a spouse or parent does, your benefits are severely capped. The state restricts you to collecting no more than 5 times your weekly benefit amount in total. There is a specific exception if you earn $7,500 or more from that employer during each of the 16 calendar quarters prior to your claim, but generally speaking, business owners face a very strict limit.
Okay, Section 4, Step-by-Step Reporting Guide.
I want you to mentally walk through these exact steps every single week. Step 1, log in to ui.mn.gov. Step 2, always select the previous Sunday to Saturday week. Step 3, enter your exact total hours worked for all employers combined. And Step 4, enter your total gross earnings. Remember, that's your pay before any taxes or deductions are taken out. The best practice here? Have your personal daily log of hours sitting right next to your keyboard before you even click login.
But what exactly counts as earnings? Well, this is where it gets kind of tricky. You have to include all tips, bonuses, and gratuities. However, you explicitly exclude severance pay, termination pay, and third-party sick pay, because the state doesn't count those as active labor hours. But here is the real kicker. You must include the cash value of rent or goods received in exchange for your labor. Yeah, so if you do some handiwork for your landlord and they knock $200 off your rent, the state considers that $200 of gross earnings and you absolutely have to report it.
Moving on to Section 5, Common Mistakes.
Let's rapid fire through the biggest pitfalls that trip people up. Number 1, estimating instead of tracking your exact hours. Don't do it. Number 2, failing to report self-employment or gig work. Yes, driving for a rideshare app or doing freelance design absolutely counts. And trust me, the state will find out because companies report 1099 income. Number 3, fractional rounding. The state rule is that fractions of 0.5 or more round up to the nearest whole hour. And finally, for you gig workers out there, waiting for an invoice to clear before reporting. Remember that performed versus paid doctrine we just talked about.
Also, please notice the clear distinction here regarding time off. If you're taking a paid sick day, holiday, or vacation day from your part-time job, you must report those actual hours and that pay for the week you took them. However, if you're simply cashing out old, unused vacation time when you leave a job, or if you take unpaid leave, you don't report those as compensable work hours because you didn't actually perform any services.
All right, let's wrap this up with Section 6, Best Practices and Disclaimer.
Here are the essential habits you need to build. First, keep a daily personal log of your hours from Sunday to Saturday. Seriously, do not rely on your memory. Second, keep your mailing address updated with the Department of Employment and Economic Development for at least 4 years after your last claim. Why 4 years? Because the state can audit you for up to 4 years. If they send an audit notice to an old address and it bounces back, they can issue an automatic fraud determination without you even knowing. Third, check your online account regularly for requests for information. And lastly, if you realize you made a mistake on a past weekly request, do not wait. Call customer service immediately to amend it before it turns into a full-blown fraud issue.
As we wind down, a quick disclaimer. While we've covered the statutes in depth today, bureaucratic rules and state laws are always evolving. This explainer is purely for educational purposes, to help you understand the framework. Always verify your specific situation directly with official state resources at ui.mn.gov, or consult professional legal assistance if you find yourself facing an audit.
I want to leave you with a final provocative question to think about. Are your personal daily work records detailed enough right now to survive a state audit 4 years from today? Take a really hard look at how you track your time and earnings. Getting into the habit of precise daily logging could literally save you from a massive financial penalty and protect your safety net down the road. Thank you so much for joining me on this explainer. Keep those records tight and stay informed.